I'm going to admit all. Good afternoon, everyone. Welcome. Just give us a few minutes here to make sure that we get everybody from the waiting room into the presentation.
Tell them to hold off at this point.
Okay, thank you everybody for joining us today. My name is Jessica McClellan and I will be your moderator for today's webinar. Before we begin, I just have a few items I'd like to go through, housekeeping items. Everybody is placed in a listen-only mode. We ask that you please keep your cameras off to reduce disruption as well as your microphones. We will be recording this webinar and a link to that recording will be provided in the days coming along with the presentation materials. We are very fortunate to have one of our tax practice leaders, Michelle Clement, on the line as well. She will be answering any questions you may have. To ask a question at any time during the presentation, you can do so by clicking in the right-hand lower corner of your screen and click on the dialog box for the chat feature, and you can submit a question. We are offering 1 hour of CPE for this webinar for those who qualify. I will let you know that all participants must be logged in for the full webinar and complete the polling questions in order to obtain the CPE certificate. It is continuing professional education, and we will be sending those certificates out in the coming days. So just be patient with us. So let's go ahead and begin. The outcome of the most recent US election sets the stage for potential tax policy shifts, leaving decision makers wondering how they may prepare for what lies ahead. The new administration is considering changes to personal, corporate, estate taxes, and broader economic policies. As the post-election tax landscape comes into focus, planning is key. Today, we have brought together two really great speakers from our tax team. We've got Ruben Becerra, a senior manager who brings more than 10 years of experience. And we have Chad Gates, who's also a senior manager in our tax department, who's been with the firm for over 8 years. Both of these gentlemen are well-versed in the nuances of the tax code, and they're really excited to share with you their insights today. And I've seen their presentation, and it's fantastic. So with that, I will pass it over to Chad.
Yeah, thanks, Jessica. And thanks to everybody for being flexible with the timing of these presentations. Last year, I think we did this in December, which would have given everybody an opportunity to put some of these planning ideas to use before the end of the year. However, with the election results, we felt it necessary to at least know the results of the election to kind of better tailor these presentations to what could be the next 4 to 8 or even longer years. And with that, that's a good segue to our first topic, legislative updates. Friday, January 3rd, 2025, the 119th Congress convened and was sworn in. The last election results basically broke the House down between 219 Republicans, 215 Democrats, and 1 empty seat when Representative Matt Gaetz resigned right before the end of the term in his bid to be in President Trump's cabinet. The Senate is made up of 53 Republicans, 47 Democrats, and obviously Donald Trump won the election for the Republican Party. This is the first time since 2017 where the Republicans controlled both chambers of Congress as well as the presidency. The margins are very slim, but again, this is the first time since 2017 where they controlled all of the things. That being said, we still have the same legislative needs that we did last year at this time, between research expenditure changes, bonus depreciation phase outs, interest expense limitation changes, child tax credits, as well as the expiration of the 2017 Tax Cut and Jobs Act.
All right, so first off, we just wanted to touch real quick on the Tax Relief for American Families and Workers Act of 2024. So some of you might recall from this time last year and during our presentations last year, we spent probably 3 or 4 slides talking about this topic because it was a big ticket item at that time. And there was some optimism at that time that something would get done with it. One, because it passed the House with decent amount of bipartisan support, and 2, because it did address a lot of those needs that Chad just mentioned, right? You'll see through the details on here. I'm not going to go through all of them. But you'll see that they hit on a lot of those things that Chad just talked about in terms of what we need from a legislation standpoint. It didn't end up obviously coming into fruition, right? It passed the House, didn't end up coming to vote for Senate, but we wanted to highlight it, 1, to kind of close the loop on it, but 2, to just say, because we still need these legislation, those legislative needs are still needed. If we have anything coming through for 2025, a lot of this stuff is likely going to be in it. Not going to be the exact same bill, but a lot of these same types of things are going to be seen as we think about legislation for 2025. And so with that, Chad's going to talk a little bit about some of the small things that did end up coming to fruition in 2024.
Yeah, believe it or not, there were a few bills that did get signed into law right at the very end of 2024. The first is the Federal Disaster Tax Relief Act of 2023. Effectively, all this does is it excludes from gross income any amounts received by taxpayers or allows losses incurred due to the wildfires, as well as the train derailment that happened in East Palestine, Ohio back in February of 2023. Nothing monumental there. It's a standard procedure. The next, a little bit more interesting, but it's also very small. This one is called the VSO Equal Tax Treatment or VET Act of 2024. A veteran or a VSO is a veteran service organization. It's similar to any other charitable organization, a 501c3, only it has a subset of rules where the membership has to be made up of at least 90% of wartime veterans for donations to the organization to be considered a charitable donation. After this law was signed into law, after this law was passed, that 90% threshold went down to 75%, opening up a little bit more for donations to be deductible. The CBO estimates the 10-year cost of this to be $1 million over the next 10 years. Again, very small, very few people are going to be affected by this, but it did pass, so we felt it necessary to talk about. One other thing that we don't have a slide for because it is so new was on Sunday, January 5th, 2025, President Biden signed into law the Social Security Fairness Act, ushering significant changes for nearly 3 million retired public employees across the United States. The new law repeals 2 long-standing federal policies, the first being the windfall elimination provision. Previously, this reduced Social Security benefits for individuals who earned pensions from non-Social Security covered employment. The next was the government pension offset. This reduced or eliminated Social Security benefits for spouses and surviving family members of those public service workers. The repeal of these 2 policies means a boost in Social Security benefits for retired teachers, firefighters, police officers, and other government employees, as well as their families.
All right, so moving on to something that you guys are probably ultra curious about is just kind of what are the incoming administration's priorities as they move into office and the new next 4 years start coming into play, right? So right off the bat, we're going to talk about this a lot throughout the presentation, is TCJA, and Chad's going to, in a second here, go through a list of all the things that are set to expire or sunset at the end of 2025. And so that's kind of priority number one with the incoming administration, is figuring out what are we going to do with those provisions that are set to expire and sunset. What are we going to do? Are we going to modify them? Are we going to extend them? Things like that. That's priority number one. Number two, one of the things that I think you're going to hear kind of in conjunction with legislation throughout 2025 is the SALT cap. So kind of high level, that SALT cap is your itemized deductions, right? Since TCJA, there's been a limit of $10,000 that you could take as an itemized deduction for your state and local taxes. With one of those sunsets is that the SALT cap is set to be repealed after 2025. And this is going to be one I think you're going to hear a lot about with legislation, because it's something that really, from a Republican standpoint, the group as a whole, would prefer the SALT cap the SALT deduction not be there, right? The issue with that, as Chad kind of mentioned, is that there's slim margins in the House and the Senate. And so there's a group of Republicans, a small group of Republicans from high taxing states that would prefer some benefit for the taxes that they pay to those high taxing states, right? New Jersey, New York, California, some of those types of states where they're not getting a benefit currently, right? And so they're kind of going to say, hey, we want some kind of SALT benefit, right? Whether that's an expansion of the cap or just the limit being gone entirely. And we want that so that we can get the other legislation passed. So that's why I think you're going to hear a lot about SALT in 2025, kind of tied in with any legislation. The next few things, right? No taxes on tips, no taxes on Social Security benefits, no taxes on overtime. Those are things that were talked about a lot during the campaign, not necessarily things that we think are going to end up coming to fruition, but just wanted to highlight them there because they were highlighted during the campaign process. Another thing, the 15% corporate tax rate. So that's corporate C Corp tax rate on domestic production. Keywords there are domestic production. There's no real kind of specifics on how that would be done. One of the theories is that there's a domestic production activities deduction that was in place prior to TCJA. So one of the thoughts is, hey, can we reinstitute that and formulate it in a way where we can get that 15% rate for domestic activities using that deduction? But again, no specifics currently as in terms of that's exactly what's going to happen. And then lastly is a car loan interest deduction on your Schedule A for US cars specifically. Could be beneficial. Obviously, cars have gone up in price quite a bit over the last several years. But again, if TCJA right now, right, standard deductions are pretty high, so not a lot of people are itemizing as it is. If that ends up getting extended, we may not get much benefit from that at the end of the day either way.
So like we've said a few times at this point, the Tax Cut and Jobs Act of 2017 is set to expire at the end of this year, 2025. So beginning on January 1st, 2026, assuming Congress doesn't act to renew any of it, all of the taxpayer-friendly provisions are set to just go away. The first one being individual marginal top rates go from currently 37% all the way up to 39.6%. The repeal of Section 199A qualified business income, which is the 20% flow-through deduction, which we'll cover later in this presentation. The standard deduction gets cut in half effectively. The SALT cap that Ruben just mentioned gets removed. The PISA limitation comes back in play. The 2% miscellaneous itemized deduction comes back in play. Child tax credit gets decreased from currently $2,000 to $1,000 for qualifying child. The personal exemptions are back, but the AMT is also back in play. Right now, there's a very high exemption amount to keep individuals from being subject to AMT. When TCJA goes away, so do those exemptions. Also, reducing the estate and gift tax exemptions, they go back to 2017 amounts, effectively cut in half to what they are right now.
All right, so we just wanted to touch on high level the Corporate Transparency Act. And Chad's going to talk here in a few minutes about some of the court cases and some of the back and forth that we've seen really over the last month or so with this act and the beneficial ownership information reporting. So don't want to go into too much detail, but just wanted to highlight it for you here real quick. So what is the Corporate Transparency Act? So it was an act enacted in 1/1/2021, set to be effective 1/1/2024, essentially requiring businesses to report their beneficial owners to FinCEN, the Financial Crimes Enforcement Network. And they wanted this information for a number of different reasons, but primarily for crime enforcement, right? They wanted to be able to say, if there's businesses out there that are doing illegal activities, money laundering, tax evasion, financing terrorism organizations, things like that, they want to know who are the owners of these companies so that they can go after them when those things come up. They brought in some hefty fines, right? You'll see there failure to file up to a $10,000 penalty. They brought in some criminal fines potentially if you fail to do some of this stuff. So they came in pretty hot and heavy with fines and potential penalties for not doing this reporting. And so the reporting is, as I said, beneficial ownership information reporting. You're reporting your beneficial owners. And so kind of high level, if you are a business that's registered with the state, you're likely subject to the Corporate Transparency Act. A couple slides later, I'm going to have just a list of 20 plus exemptions that you could fall under where you wouldn't be subject to the reporting requirements. But again, really high level, really basic. If you're a business registered with the state, you're likely subject to the Corporate Transparency Act. And so when you're reporting that information, the beneficial owner is the key piece, right? And so who is a beneficial owner? There's kind of one kind of straightforward definition or criteria of a beneficial owner that owns or controls 25% of an interest in the company, directly or indirectly, pretty straightforward. The one that's way more nuanced and a bit more broad is the substantial control, right? So if you're deemed to have substantial control of a business, you're deemed to be a beneficial owner, need to be included on this report. That could be a senior officer, someone that has the authority to appoint or remove officers, anyone that's an important decision maker. What does that mean? Anyone that's kind of the catch-all, right? If you have any other form of substantial control, then you have substantial control. Again, what does that mean? Not super clear. So they make it very broad so that they're making sure that they're just catching everybody in that. So let's say, okay, you need to file, what are you reporting? The reporting honestly is very straightforward for the vast majority of businesses. And we had a team here at WBC that we put together to help businesses file these reports. And overall, the reports were 5, 10, 15-minute process, depending on how many owners there was and how complex ownership structure really were, right? From a reporting company standpoint, you're sending your name, address, state of registration, EIN, right? From the beneficial owner standpoint, very basic information, name, date of birth, address. You're sending a copy of your driver's license. Again, 5 to 10-minute process to send this information and file these reports. So nothing super crazy. Next, here's a list of just, like I said, the 20 plus exemptions to this act. Big ones that we've seen: one, tax exempt entities. Those are 501c3 specific entities. If you fall under that, you're exempt from reporting. The other big one, large operating companies. I'll talk a little bit more about that here in a second. And then subsidiaries, that's another big one as well. And then you'll see their accounting firms, just because we have a good lobby system, right? We tend to be exempt from some of this stuff, but so large operating company. So that's one of the big ones we've seen with a lot of our clients that have fallen under. To qualify for that exemption, you have to have employed over 20 full-time employees in the United States. You have to have had sales greater than 5 million sourced to the United States on your previous tax return. You need to have a physical presence, right, an office in the United States, and you have to have been taxed as a corporation, S corp, or partnership. You hit all of those criteria and you fall under that exemption and you don't have to report. The second one, the subsidiary exemption, very kind of similar in that it's if you're owned by an exempt corporation, with exceptions, because there's always exceptions, you can be exempt from reporting as well. So with that, Chad's going to talk a little bit about all the up and down that we've had over the last month.
Yeah, to say there's been a few court challenges about this would be an understatement. As of the writing of this presentation, there were 4, with one super notable one happening down in Texas. Since then, there's been 2 additional ones, so 6 total. 3 of the cases were ruled that Congress had the authority to enact the CTA, no changes necessary. However, 3 of them ruled that the Congress exceeded their authority and that the Corporate Transparency Act and the subsequent enforcing by FinCEN is unconstitutional. 2 of those 3 court cases, the judge issued an injunction just for the plaintiffs in the case. However, the one we're going to spend a little bit of time talking, the Texas Top Cop Shop Inc. versus Garland, happened on December 3rd, 2024. That judge ruled that the CTA exceeded Congress's authority, deemed it unconstitutional, and then issued a nationwide injunction. So we all got great news in the morning of December 3rd. However, it was short-lived because on December 23rd, obviously the Biden's Department of Justice was unhappy with that ruling and injunction. They immediately appealed for an expedited appeal review. The small panel inside of the Court of Appeals ruled that the injunction was invalid, reinstituting the CTA and the filing requirements. I think I put a slide together here that has all of the new reporting requirements as of that date. They effectively just pushed everything back a couple weeks to make up for the time that everybody was exempt from filing. But 2 days later, on December 26th, all of that got reversed again. Same Court of Appeals, different panel, reinstituted the nationwide injunction, barring enforcement from FinCEN. That's where we're at right now. Again, the Department of Justice was unhappy with that ruling. They immediately, a couple days later, requested an emergency appeal with the Supreme Court of the United States. That happened on December 31st. We have not heard anything else from this case related to that. Barring what the Supreme Court does on this emergency appeal, the regular Court of Appeals is scheduled to hear this case sometime late February, early March. We don't know how that's gonna shake out. Assuming that the Court of Appeals rules that the CTA was within Congress's authority and everything's fine, just when the case is scheduled to be heard, it's entirely possible that April 15th could be the new deadline for all these initial BOI reports. Like Ruben said earlier, we are helping clients file these things, and we have time to help people now. There's no harm in filing early. We can voluntarily file and comply with the Corporate Transparency Act, get all the reports filed now. If the CTA is deemed unconstitutional after all the court challenges are exhausted, theoretically that database just gets deleted and all that information goes away. But as of right now, there's no harm in filing, and we have time to help now. We're not going to have time to help if the due date's April 15th and we find out about that on March 15th. No one's going to have a whole lot of fun with that if that's the fact pattern. No one's going to have time to help. You might be able to find some attorneys that aren't super busy around that time, but you're not going to be able to find a CPA firm that's going to be able to help you do this stuff when they're focused on audits and wrapping up year-end tax returns. But to reiterate, as of right now, that's not the case. There is no filing requirement, and there are no penalties for not complying with the CTA. Just want to make sure that was clear because we went back and forth like 4 different times in the last 30 days or so. Looks like we got a poll question.
Yeah, I went ahead and launched it, so go ahead and please submit your answer. Again, this is important if you want your CPE credit. Alrighty, everyone answered. So I'm gonna go ahead and end the poll, or no, 76%. A few more seconds here to answer your poll. Okay, I'm ending it. All right, go ahead, Chad and Ruben.
All right. Let's see here. All right, so moving on, now we're going to talk a little bit about individual tax law specific items. So one of the things we like to do in these presentations is just present the tax brackets for you guys. And the reason we like to do that is 1, just so you guys have an idea of what those brackets currently are. But 2, we also like to just explain a little bit of what we're looking at when we're looking at things from a tax planning perspective, right? So one of the things, one of the big things that we try and look at is just bracket maximization, right? So we try and look at the brackets and say, okay, where can we, where do we have some wiggle room to play with things? And really kind of in terms of, if you typically find yourself in one of those higher tax brackets, or maybe you're typically at that highest tax bracket of 37% right now, right? And for whatever reason, business had a down year, you had lower income, for whatever reason, you're down in that 35% or even 32% bracket for this year, and you fully expect next year, and if you're going forward, that you're going to be in that high tax bracket. Well, one of the things we can do is say, okay, how can we maximize those lower tax brackets that you're in now? You're expecting to be back at those high tax rates down the road. What can we do to maybe recognize some income or maybe pay taxes on some income so that you get the benefit of having those lower rates instead of that higher rate that you're typically at, right? So one of the things we can do is like Roth conversions, right? Maybe you're at that 35% rate and you have some IRAs out there, and we say, okay, let's convert some of that money to Roth, pay the tax on it now. You're going to save a few percentage point, a few percentage rates on that and get some tax benefit from that. And kind of one key with that, right, is that just an overarching, right? Rates are just at historical lows right now. So it's not a bad answer to pay tax on it. And so we kind of take all that stuff into consideration when we're looking at things from a tax planning perspective, right? And so moving on to 2025 tax brackets, no real big changes here. Really just kind of inflation adjustments from the year prior, nothing real major. This next slide here, I will apologize if it causes any heartburn or potential nightmares when you're trying to go to sleep at night. But this next slide is the potential 2026 tax brackets, assuming no legislation gets passed in 2025. So as we've talked about, and as we'll continue to talk about, a lot of things potentially ending at the end of 2025, making 2026 potential tax brackets significantly higher, right? Taxes significantly higher for a lot of people in 2026. So one of the things that you can look at here at these rates, and you might immediately go to, right, the high tax bracket in 2025 is 37%, 26 is 39.6%, and you say 2.5%. Okay, not a huge deal. But one of the things that I'm going to go back here to 2025 real quick, and you can see if we find where $100,000 to $200,000 is at for a single taxpayer, and where about $200,000 to $400,000 that is it for a married taxpayer in 2025, you're in the 24% bracket. So if I move forward here to 2026, and I try and find those same kind of ranges for 2026, right? So for single, $100,000 to $200,000, it's 28% bracket, right? So just overnight, you move from a 24% bracket to a 28% bracket. No major shifts in income, no big promotions, no changes and things like that. You're just automatically paying 4% more in tax overnight. From a married filing joint standpoint, you'll see there's 150 to 230 is 28%. So again, higher by 4. But the bulk of that $200,000 to $400,000 range is in that 33% bracket now in 2026. So all of a sudden, again, overnight, it's a 9% increase in your tax rate, no changes in income, no big promotions. It's just overnight, you're paying 9% more in tax. So some big potential changes there. And from a 39.6% standpoint, again, you might say 2.5% to the 37% in 25, not a big deal, but for business owners, potentially a huge deal, right? So right now, if you're at the highest tax rate, tax at the highest tax rate for 2025, 37%, and you're a business owner, and you qualify, which we're going to talk about here in a second, the qualified business and conduct deduction takes 20% of your income, and you qualify for that full 20% deduction. Your effective rate right now on your business income at that highest tax bracket is 29.6%. Again, same income, you're at the same tax bracket, and you move forward into 2026, you're at 39.6%. So it's a 10% increase, again, just overnight. So, I think the expectation is that something's going to come in 2025, this legislation, and that this scenario is not going to happen. But we wanted to highlight it because we've thought about that. We've thought that about legislation in the past, right? We thought that about Section 174 R&D expenses. We thought that about the the Relief Act that we talked about previously, right? Where there was some optimism that something was going to get done. So as much as we think that something's going to get done and we kind of have optimism that something's going to get done, it's Congress, right? It's politics. We still don't know for sure. So we wanted to highlight what those brackets are just to give you guys an idea, right? And so moving on to cap gain rates for 2024, no real changes there. No big expected changes for 25 or 26 there. But that, again, the big range is that 15% bracket there that we try and kind of maximize where we can.
Shifting gears a little bit here to the net investment income tax. this isn't a new thing. This has been around since January of 2013 with the enactment of the Affordable Care Act. This is just a 3.8% surtax on all investment income. Investment income is derived from annuity distributions, interest and dividends, passive income, rents and royalties, and disposition of property not held inside of a trade or business. Trade or business income, even interest derived from self-rentals from trade or business is not subject to the NIT, but everything else effectively is. As long as if your income is over certain thresholds, all of that investment income becomes subject to the NIT. Those filing thresholds are 200,000 for a single individual, 250,000 for a married filing joint, or $125,000 for married filing separate. One thing you can kind of do to as a planning opportunity, looking ahead for the NIT in your retirement years, are Roth conversions. When you take distributions from a Roth account, that income is not considered modified adjustment of gross income for NIT purposes. However, if you do a Roth conversion to get more of your money from traditional Roth accounts, that conversion itself is considered modified adjusted gross income for NIT purposes. So if that's something you want to do, try to keep more of your income away from NIT in the future. Do Roth conversions, but you want to spread those out over enough time that the year that you do the Roth conversion, you're not also subjecting yourself to that 3%, 3.8% NIT on your investment income in the meantime.
So real quick, just kind of some estate and gift tax updates. From an annual gifting perspective, over the last several years, it's kind of been a $1,000 adjustment year over year. No different for 2025. That annual gift tax exemption is $19,000 for 2025, $18,000 for 2024. From a lifetime exemption standpoint for 2024, single, that exemption was $13.6 million. Lifetime exemption married was $27.2 million. The 2025 exemption, I think, is final now, so that's $13.9 million, basically $14 million. For single, $28 million for married. Again, the big one of these things that's going to potentially change here in 2026, that exemption, that lifetime exemption, the state exemption is set to essentially be cut in half, right? $7 million for single, $14 million for married. Big takeaway there is to say, just watch, right? Watch for legislation, see as things come, and if there's any estate planning that you've kind of been thinking about needing to get done, putting it off the back burner, now's the kind of time to start picking it back up and talking about it and getting a plan set in place just in case something doesn't come down the pipe for 2025.
Ohio House Bill 33, we talked about this a lot more last year. This isn't a new thing, but we felt it important to still have it in here, mainly for the commercial activity tax piece. If you remember a few years ago, the Ohio commercial activity tax was required to be filed and paid by all Ohio businesses with Ohio business income of greater than 150,000. Ohio House Bill 33 comes. That $150,000 filing threshold increases from $150,000 to $3 million effective 1/1/24, and then effective 1/1/25, that filing threshold again increases from $3 million to $6 million. This effectively takes most of the small businesses out of having to file and pay the annual minimum, which is nice from a compliance standpoint, and it keeps more money in the business owners' pockets. Another thing it covered was enacting the pass-through entity tax, which we'll cover here in a little bit, as well as it changed the individual tax rates quite a bit, which we'll talk about here in a minute as well. Another thing I want to touch on here is new reporting requirements for 1099 digital assets. It came out, or there's a draft of it out that came out on December 31st, 2024. The 1099 DA covers all transactions for digital assets. Examples of digital assets would be cryptocurrencies, non-fungible tokens, or things similar to those. Anything held by an entity deemed as a digital asset broker would be required to report it on these things. Whether you traded it, sold it, it doesn't matter. That reporting entity would be required to furnish these reports to you as well as the IRS. We have something similar right now. It's called a 1099-B that reports stock sales, proceeds basis, date of acquisition, date of disposition. All of those things are required to be reported on a 1099-B right now. Same thing will be required on these things, just with cryptocurrency reporting, which is nice from a tax compliance standpoint. Right now, a lot of these brokers, think of like your Robinhood cryptos or even your Coinbase. Right now, a lot of those people will just send you a Excel sheet. Maybe they might include the Excel sheet, probably not though. So from a compliance standpoint, it's always interesting to see what kind of information you're going to get going forward. 2025 going forward, that should get a little bit more standardized. It's probably not going to be perfect when it gets rolled out, especially the basis standpoint. If you remember 10, 15 years ago when the 1099Bs started to become required, basis was always squirrely. It'll likely be the same thing with these digital assets. But as time goes on, I would expect those to become more and more relevant and more accurate.
All right, so with that, just a little bit of Ohio and state-specific stuff here from an individual's perspective. So the Ohio tax brackets really just kind of a similar idea as the individual tax brackets. We just kind of like showing them so you have an idea of what they currently are, both previous year and current year. As Chad mentioned, that Ohio House bill had a big effect on the 2023 rates, essentially eliminating the top bracket there, but no big changes from 24 to 25 that we're seeing from an Ohio tax standpoint. Next, so this notice 2020-75 and the SALT deduction. So this is something that's been in our presentations here for the last 3+ years or so. And really kind of the main takeaway from this slide is that at this point now, there's a vast majority of states that have instituted pass-through entity taxes for pass-through businesses that they can elect into from various different, right? All the states you get into state tax, they all have different requirements, different regulations, different laws, things like that. So each state you have to look at to get the specifics on them, but the vast majority of them have instituted these pass-through entity taxes whereby businesses pass through, specifically, right, partnerships, S corporations, can elect into these pass-through entity taxes, deduct the taxes that they would pay are paying to the states, deduct them at the federal level, reduce their federally taxable income, and get a benefit for those state taxes that they're paying, which otherwise would have been capped, as you'll see there at that $10,000 deduction that we've talked about a couple of times now, right? So typically, as an individual level, you wouldn't have gotten the benefit for those; they would have been limited based on that $10,000 cap on your itemized deductions. Now you're getting the benefit; you're reducing your federally taxable income, and getting a benefit for those taxes that you would have otherwise not gotten. So that's kind of a big takeaway from this slide. And what the notice really hinted on was the IRS is saying, we're going to allow businesses to do this, or we're going to allow states to do this, and we're not going to fight that deduction at the end of the day. And so after this notice, you saw a lot of states start instituting these pass-through entity taxes. So Ohio specifically, Ohio has this. It came about a couple of years ago now. You file it on this form 4738. By making the election, you just file the return, right? Make your payments. It's a 3% tax rate on your business income. And essentially what it is you file this tax return at the business level, you pay $10,000 of the tax that you owe. When you go to file your individual tax return, you then have a $10,000 credit to take on your individual Ohio tax return. And that's essentially how it works, right? So kind of looking through that and kind of skip back to this slide here. So one of the big things from an Ohio standpoint that we wanted to kind of hit on, and some of the interesting things that it brings about, are just one from a tax refund perspective. So think about, okay, you paid this $10,000 for business. You actually had an individual tax liability to Ohio of $8,000. Now you have a $2,000 refund. So you say, okay, what do I do with that, right? Well, first off, what do we think about, right? Well, Ohio has this business deduction where you're able to take a deduction for the first $250,000 worth of your business income. So the first question there is that $2,000 tax refund eligible for that deduction, right? Is it business income that we can then deduct off our tax return on Ohio? We think so. I think that's what we've done a lot for Ohio returns. The issue is Ohio hasn't agreed with some of the things that we've done on those tax returns, even though we think it's fairly clear in the regulations, and when you read some of those things that this is how it needs to be done. Ohio doesn't necessarily agree, so there's some nuance there. The other thing with that is from a QBI perspective, right? If I take this $2,000, is that $2,000 qualified business income that I can then take that 20% deduction on? We think so. The IRS doesn't have any specific guidance out there on it though. And we'll talk about this from a taxability standpoint. We're likely not going to get any specific guidance from the IRS on it. These pass-through taxes essentially go away if the SALT cap isn't there, if the SALT cap goes away, right? They were instituted specifically for that. A lot of them have written into the laws that if that SALT cap's not there anymore, then the pass-through entity election isn't there anymore. And so the second thing there from a taxability standpoint is that $2,000 taxable refund that I just got now taxable income that I need to pay. Again, something we think so, at least to a certain extent. But again, no formal guidance out there from the IRS on it. A couple other things to keep in mind from an Ohio pass-through standpoint is the depreciation add back. Ohio doesn't allow bonus depreciation or 179 to a certain extent. So you have to make sure you add that stuff back when you're filing those returns. And then lastly, just thinking about when you make those payments and the deductibility of those based on that. And then the other thing to keep in mind is that Ohio, at the end of the day, doesn't want to be harmed by this, right? So you're getting a deduction for that tax that you paid at the federal level, but at the Ohio level on the individual return, they want you to add back those taxes, right? So that they're essentially whole. They're not doing this to benefit you from an Ohio standpoint. They're doing it to benefit you strictly from the federal standpoint. So just one other thing to keep in mind there on the pass-through side of things.
Yeah. One last thing I wanted to add related to the Ohio pass-through entity tax is it only applies to partnerships and S corporations. If your business is a Schedule C on your personal return, or even a Schedule F or a rental Schedule E, those don't qualify for the pass-through entity tax deduction. It has to be on a partnership or S corp return. Just a couple general tax planning ideas as we wrap up the individual section. Remember those tax rates, the 24 to 25 to 26. We want to maximize lower rates the best we can before they increase. Again, at the end of this year, they're set to increase barring legislation. So we want to take advantage of those the best we can. We can do Roth conversions. Those are very, very popular for 2024. We want to maximize if we want to do loss harvesting or even gain harvesting. If you had a lower income than you normally would, increase some of that income to take advantage of those lower rates. We could also do itemized tax and charitable grouping. Effectively, what that means is if I give $5,000 to a certain charity every single year, I'm going to accelerate some of that to the current year, do $10,000 this year, forgo the donation next year. The charity doesn't care because they're still getting 10 grand over that 2-year period, but you potentially just got a bigger bang for your buck, either allowing you to itemize for the first time or getting more of a deduction for having more charitable donations in that year. You could also do what's called a qualified charitable donation or a QCD right out of your IRA. There's certain thresholds with that, but effectively you never pay tax on it. It goes straight to the charitable organization. It reduces your income from all the other things. It's a great tax planning opportunity that a lot of people don't know about or don't take advantage of. Consider making the pass-through entity tax election. Ruben just spent a bunch of time talking about, and retirement fund maximization. Make sure you're taking advantage of elective deferrals from your job. Fund 401ks, IRAs, do backdoor Roths, fund a Roth. Another thing is if you happen to have self-employment income one year that you typically don't, a planning opportunity that's very lucrative would be setting up a SEP or a simplified employer pension. Get a 25% deduction on your self-employment income and get some more monies in those protected accounts. And with that, we're going to we got a CP polling question.
Yes, we do. Let me go ahead and launch that second question for you guys. Just bear with me. Oh, hold on a second. It won't let me. Hold on. Oh, it's not. Okay, hold on a second. Sorry, guys. All right, launching question number 2. And this is an important one for all those people out there that need that CP certificate. 76% of you have participated. Give you about a few more seconds here. If you need a CPE certificate, please go ahead and click yes. And like I said, they will be coming in a probably next week. All right, I'm gonna go ahead and end the poll. All right, go ahead, gentlemen. Thanks.
All right, so with that, we're going to transition over into some business tax law topics. So first off, succession and estate planning. And there's no real kind of big changes with this necessarily, other than the fact that, again, as we've mentioned, the estate exemption is set to be cut in half at the end of the year. But this is really just kind of a topic we wanted to touch on real quick. That is something good to think about as you kind of get into a new year, right? End of previous year, get into a new year, something to think about. So one of the things, one of the big things with this is just starting early, right? So beginning to plan at least 5 years in advance prior to transition, expected transition. It really just gives us a lot of flexibility to help from a planning standpoint, right? We'll have a lot of clients that'll come to us the year up to say, hey, I want to get out of the business this year. And it really just kind of limits what we can do for them from a business, from a tax effectiveness standpoint, right? Second, make sure you're kind of thinking about who you want to take over the business, right? Whether that be family, employees, external buyers, just developing a plan for that standpoint. Third, making sure you kind of always have just an idea of what your business is worth, right? Again, super important this year because of those exemptions that are set to change, but just kind of always have an idea so you have a good strategy of what that is. And then lastly, obviously just seek professional guidance. You know, your attorneys, your CPAs, your financial planners, that's what we're here for. We're here to help and consult on these items. So definitely don't try and do all this stuff on your own. That's what we're here for. We want to be a part of those conversations and help as you're going through some of those processes and things. Next, we wanted to touch on the R&D credit form changes that are expected to come through 1/1/2025. So again, these are effective for tax years after December 31st, 2024. And I'm not going to go into all the detail there on the slide. I really just kind of high level wanted to point out to say, if you our business have an R&D credit study done, that now's the time to kind of get in contact with your R&D study provider, because there are some changes on the docket, some changes that are going to require some more information, right? You're likely going to have to change some of your processes that you do to make sure you have this, you compile this information that you need, and your R&D study provider is going to be able to set you up in the best way possible to do that. So just know there's some changes expected for 2025 if you want to be able to claim that credit and claim it to the extent that you've done in the past. So make sure you're talking to your provider so that you can have those all set in place now without having to think about it end of the year type thing.
Yeah, and continue down that path of R&D changes. The dreaded 174 change took effect on years beginning after 1/1 or beginning after 12/31/2021. So effective 2022, 2023, and this year, all of the research costs associated with those R&D studies must be capitalized and amortized over 5 years for domestic costs and 15 years for international costs. Again, this was part of the TCJA of 2017. It had a delayed effect date, so this has been around for a while. It just got implemented a couple of years ago. This is one of those pay-fors to pay for the rest of the TCJA's tax cuts. Ideally, it gets fixed in legislation that happens later this year, but we'll see what happens. The first year we had to do this was tax year 2022. We extended most of those returns, hoping for either a fix or additional guidance as this stuff came out. We got the guidance, the first guidance on like September 7th. And returns were due on September 15th that year. So that's what all these notices were that we're going to touch on briefly. Then over to Ruben for bonus depreciation.
Yep. All right. So from a bonus depreciation standpoint, really just big change there is that, as you can see, since 2022, we've had a 20% decrease in the allowable bonus depreciation each year. 2025, that's down to 40%. 2026 is set to go to 20%, and then after that, it's set to be 0. This is one of the things that we expect to see in legislation, assuming legislation comes through. So just kind of keep that in mind as we go throughout the year, but wanted to highlight where it's currently at least right now.
Qualified business income, this again's been around since the TCJA has been a thing, so effective 1/1/2018. This is the 20% deduction on all business flow-through income. Like Ruben mentioned earlier, it takes our top tax rate for business income down from 37% to 29.6%. It was introduced as a way to lower the tax gap between C Corp rates at 21% and the individual income rates at 37%. It's subject to certain limitations, such as if you're a specified service trader business or just a regular qualified business income. We're not going to get into all of that today. But the key thing to remember here is this all is set to expire on December 31st, 2025. Whereas the C Corp rate is permanent. That is not set to expire at the end of this year. That will remain at 21% going forward.
Right, so forms 1099Ks, this is something we've been talking about really for the last several years. It was something that was supposed to come into full effect, I think, in 2022. There was some pushback on it, ended up getting nothing coming through for 2022, and then made 23, 24, and 25 transition years for it. So essentially, this was if you got third-party payments in excess of $600, and where this was a big kind of ticket item was like things from Venmo, or like you're selling things on Facebook Marketplace or whatever, right? And you pay for it above 600, that Venmo was going to send you this 1099K, and you're going to have to report that income on your tax return. Again, you were supposed to be reporting that income on your tax return either way. Who's reporting the 20, 30, $600, $700, $800 on their taxes? Not very many people, right? So this was just kind of the IRS trying to hold people accountable to make sure that they're getting all the income that they should be reporting on. So you'll see there, 2024 was one of those transition years. That was a $500,000 threshold. If you didn't have payments above that, you weren't going to get one of these 1099Ks with no minimum number of transactions. 2023, I think that threshold was like 20,000 with 250 transactions. 25, again, the last transition year, that threshold is lowered to $2,500. So if you receive payments above $2,500, you're likely going to get this 1099K from these third parties. 2026 is when it finally goes into full effect the way it was originally set to go effect. That is $600 threshold from third parties with no minimum number of transactions. So that's likely when you're going to see a lot of these 1099Ks coming your way if you do a lot of this stuff, right? From a personal standpoint, how do you report these items? So if you made money on the sale, you report it as a gain on your Schedule D. Pretty straightforward. If you lost money on the sale, well, it's a personal item, so you don't get to deduct that loss. You have to report it on Schedule 1. You report the income from the 1099K, and then you later have an adjustment backing off that income, essentially making it zero line item. Same thing if you think you got one in error, right? You report the income, Schedule 1, back it off as an adjustment, zero line item at the end of the day.
Okay, now we're just going to touch on a few business provisions that have changed over the years. The first being Schedules K2s and K3s. All this does is on flow-through returns, your S corps or partnerships. It reports on a standardized form international tax items. Everybody is required to comply with these and provide the K2s and K3s unless they meet certain exemptions. These exemptions are very simplistic. For this purpose, is you got to be a U.S. citizen as a member, as a partner, or an S corp shareholder. You can't have any foreign activity besides investment income, and specifically there, you can't have more than $300 in allocable foreign tax credits total. You have to notify the shareholder or partner in writing that you're not going to issue the K3s, and after you've done that, they can't then request a copy of the K3 within 30 days of the extended due date or the regular due date of the return. If those 4 conditions are met, you are exempt from filing the K2s and K3s, which saves a lot of paper, a lot of time, a lot of compliance costs. Next is shareholder basis. A couple of years ago, S corps started requiring a form called a 7203 be included with their individual return. A lot of CPA firms and a lot of S corporations issued the 7203 with the K1s for the shareholders, which is helpful when you go to do the individual return. But similar to when we talked about the 1099 DAs and the 1099 Bs, it still falls back on the individual to make sure that basis information is correct. That that S corp or that CPA firm that prepared the S corp might not know exactly what beginning basis is, depending on how you acquired the shares. So it still falls back on the individual to make sure it's accurate. NOLs, these have changed quite a bit over the last decade or so. Years prior, you were able to take a net operating loss, carry it back, generate a refund. With the TCJA, you lost the ability to do that, and it was a carry forward only. And when you did carry it forward, it was only able to deduct 80% of the taxable income for the year. Interest expense limitation under 163J. This was also part of the Tax Cut and Jobs Act as a pay for. The first few years that this was implemented, you were limited to 30% of adjusted taxable income, which included an add back for depreciation and amortization. Effective 2022 and going forward, you are no longer able to add back depreciation and amortization, lowering that adjusted taxable income, therefore lowering the amount of interest expense you're allowed to deduct. Any unallowed interest expense that you couldn't deduct in the current year just gets carried forward and treated as additional interest, subject to the same limitations in future years. Another one is partnership recourse debt. Recourse is generally defined as if you signed a personal guarantee with a bank. If the entity collapses, the bank can go after the individual owners who signed on the debt to collect the debt. If that's the case, you fit that fact pattern. All they require is a little bit of additional disclosure on the partnership return itself and on the K1s. And then real quick, Section 179 limits do increase every year with inflation. For 2024, the number is $1,220,000, but that starts to phase out if your income is over $3,050,000. And as always, Section 179 cannot create a tax loss. Real quick on meals and entertainment, nothing's changed here, but it's always nice to talk about because this is one of the high risk areas in an audit. They always want to talk about meals and entertainment. First off, to be 100% deductible item, it has to be for use of the general rank and file of your company, not necessarily the highly compensated employees. Examples of this would be summer picnics and Christmas parties. For it to be a 50% deductible item, there's 4 general criteria. The first is the meal has to be ordinary and necessary, just like any other expense of the business. It can't be extravagant given the circumstances. Somebody from your company, either you or a representative, have to be present at that meal, and there has to be a clear business connection. If those 4 things are met, it's a 50% deductible item. Everything that's not in the first 2 is a 0% deductible item. Example would be entertainment or meals not separately stated from the entertainment expenses.
All right, so just a couple more quick slides here. So ERTC, we're so close to not having to talk about this anymore, but just not quite there yet. So the IRS started processing these again in August 2024. There was a moratorium that had been in place since September of 23. So about a year that they delayed processing these. So if you're kind of waiting for a claim, hopefully you start hearing something soon if you haven't already. They are focused on processing high risk and low risk claims first. And processing is taking longer. I think when they originally started, it was taking about 6 months, so it's taking even longer than that for them to process these things and get them resolved. And if by chance you haven't made a claim on any wages paid in 2021, you think you're eligible to make a claim on this, we haven't talked about all the eligibility requirements, and you can go on and on about it. But just know that if you think that is the case and you haven't made a claim, you can still make a claim up until April 15th of 2025. So just kind of something to think about.
Okay, real quick, some general overview tax plan ideas for deductions. If you're considered a small business taxpayer, which is generally $30 million in gross receipts over the last 3 years, you would be eligible to be a cash basis taxpayer versus being an accrual basis. You could potentially be able to deduct the cost of inventory as a supply rather than have to capitalize it and track it. And you'd also be able to deduct prepaid expenses so long as that prepayment period doesn't exceed 12 months. We also want to take good care for our assets placed in service. Specifically, if something could be placed in service in December versus January, as bonus depreciation starts to phase out or continues to phase out, It makes a big difference if it's in 25 versus 26. We also want to take a look at the lives for potentially shorter lives. If something could be a 3 versus a 5 versus a 7, it matters now more than it has in the past. LIFO, or last in first out inventory method. In periods of high inflation, this could be lucrative. You want to get rid of the latest inventory first to potentially have a higher cost. Consult your tax advisor if that's something you're more interested in, to take a deeper dive to make sure it'll be applicable to you. If you are an accrual basis taxpayer, annually take a look at your outstanding AR. Write off any bad debts. No use continuing to pay tax on money you'll never receive. And then one last fun one, just to end on a high note, the Augusta rule, made famous by Augusta, Georgia in the Masters tournament. It basically allows you to rent out your personal residence for 14 days and not have to pick up the income. A tax planning idea around that is if you own a business, you could rent your house for a corporate event, so long as it meets the 14-day rule. You could take a business expense deduction for that cost, and then you could not have to pick up the income on the individual side.
Lastly, if you wanted to recognize income, not as common, right? But as we talked about, rates set to go up in 2026. If nothing gets done in 2025 and you want to put some more income into 2025, you could change from the cash to accrual method. As Chad just mentioned, accrual to cash, typically tax savings, cash to accrual, typically more income in the current year. You can accelerate your taxable gains, or you could delay paying accrued wages past 2.5 months to push that deduction out into the future, the next year. So that is it. Lastly, in summary, timing is everything. We've been saying this really for the last few years. 2026 is not that far away. Now it's really not that far away. And then lastly, all eyes are on Congress, right? It's really just set to see what's going to happen. And we're just kind of wait and see mode with it. So with that, thank you everybody. Sorry for going 1 minute over, but appreciate you guys listening on, and hope you got some good information out of it. So
yeah, thank you everybody for attending. Like as I said, we will be sending out an email with the recording of this session along with the presentation documents. We will also be sending out those of you who need a CPE certificate. That will be coming out as well. Like I said, please be patient with us. We had over 150 people that registered for this, so give us a chance to get those out to you, and we really appreciate it. We look forward to providing you with additional information on future events. Thank you, everybody. Bye-bye.